All right. Hey, everyone. This is Stan from commonsensestrading.pro, and today we have a conversation with Mr. Ivaylo Ivanhoff, the stock trader. So, hello. Nice to
Hey guys.
Yeah. And let's get started. Well, the first question, which is interesting for everyone, how did you become a trader? How did you come to the trading industry? So, how long ago has it become when you become a trader?
Mm-hmm. So I don't know if you know, but I'm originally from Bulgaria.
Yeah, I know.
And in the early 2000s, mid 2000s, the Bulgarian stock market was on fire. So I opened a small account there, and I turned the equivalent of $5,000 into 20,000 in just a couple years between 2004 and 2005. And after that, they moved to the US to study finance. So I spent a few years in St. Louis there, and I just got interested in the U.S. markets and just gradually started reading about them, started reading books about them, tried different strategies, made a lot of money, lost a lot of money. And over the time, I just found the right strategy for my personality and for my type of lifestyle that I'm seeking. So right now I'm a swing trader.
Yeah, and well, why did you become really a stock trader? Because there is a distinction between futures traders and stock traders, like the famous competition between Chicago and New York. For example, previously I was taking an interview from Andrea Unger, who is a futures trader, and you are a stock trader. So many people are getting to the stock market differently. Some start trading futures markets. Why did you become really?
Yeah, absolutely. I mean, to trade futures, first of all, you need a lot bigger capital, and most young people just don't have the capital. Not to mention the knowledge.
Yeah.
To start trading futures. And I've never traded forex in my life. I don't know why. I just never.
Not a single trade.
By accident, I think in 2002, I was traveling from London to Bulgaria, and I had a few hours to spend on the airport, and I had like probably 20 pounds in my pocket. I went into a bookstore there, and I looked at in the finance section. I found a book about stocks there, and I just bought it. It was a book by Motley Fool, and I just started reading it. And that's how I got interested into stocks, and just stocks made sense to me just because theoretically, when you buy a stock, you can participate in the growth of a company, even though there are way too many other factors that you can take into account. But at the time, that made sense to me. And futures and forex, I mean, I didn't know that at the time, but even with today's knowledge, I would have never started trading futures or forex just because of the leverage involved. And as Charlie Munger, Warren Buffett's partner, he likes to say that there are three things that can ruin a man: women, alcohol, and leverage. And he's not sure about the first two. So especially if you don't have the necessarily skill, leverage can kill you. I mean, of course, you can make a lot of money in the right markets, but if you're a beginner, you should stay away from leverage.
Yeah, but in the stock market, the volatility can also be quite big, especially if you're trading momentum stocks like you do. The volatility can be really tremendous during some market conditions in comparison to futures, where, well, volatility is not very big, but of course there is a leverage effect, and the effect in trading might be similar. So now, from your today's perspective, you can really choose market. So you would choose the stock market.
Yeah, I've developed an edge in trading stocks, so I stick to what makes me money.
Yeah, okay. And I know that your main approach to the market is to select and trade the momentum stocks, the one names with high beta, which should outperform the benchmark during bullish rallies. And you employ mostly breakout setups, including anticipation setups. So I know your toolkit I use, by the way, the same toolkit most of the time. Why did you gravitate to this kind of approach? And how do you think is it possible to gain alpha in the long run employing breakout strategies? Because markets are efficient now, and there is a mean reversion activity, much mean reversion activity, which sometimes dominates the price action.
Well, first of all, I don't believe the markets are efficient, and they've never been, and I don't think they ever will be. And there are so many proofs that they're not efficient.
Maybe not momentum stocks.
For most stocks, I don't think the markets are efficient.
Okay.
Just in general, the market is forward-looking. It tries to guess the future 6 to 12 months ahead, but that doesn't mean that the market is always right about that future. So just the way momentum stocks trade, the market comes up with a thesis that this company has a tremendous potential. Let's give it the benefit of the doubt, and that stock can double or triple before it reports their first profitable quarter. And then 2-3 quarters down the road, that company actually needs to start proving the market that the market's thesis was right.
Mm-hmm.
So the market is constantly waiting for that feedback from the company. And if the company starts to confirm and to exceed market expectation, that trend continues. And if the opposite happens, if it misses expectation, then we can see some violent corrections. But back to your point, why do I trade? Why do I swing trade? Why do I buy breakouts? And why do I buy anticipation setups in momentum stocks? I think my edge comes not so much from equity selection, even though it's important. My edge comes from more from market timing. I think the most practical risk management tool is to know what type of setups when to trade. Because if you look at the statistics of the best performing traders, swing traders or investors, you realize that either, if you're a long-term investor, either 20% of your stock accounts for 80-90% of your returns, or if you're a more active trader, probably 6-7 weeks of the year will account for 90% of your annual profits. So it's really important to learn to recognize when the market is healthy, there is a strong uptrend, or when the market is sick, there is a strong downtrend, and to capitalize on those short periods of time every year, because this is when you'll make most of your money, and the rest of the time is just basically just sitting there.
Yeah, about market timing. So how did you develop this market feel, or do you have certain tools for identifying the correct timing?
Yeah, I mean, I look at the price action in momentum stocks. I look at how the market reacts to earnings. For example, how I knew that I think that we could have a decent rally in January and early February. I looked at how the market reacted to earnings, and I saw that the market was reacting favorably even to companies that were missing earnings estimates. And when you see a positive market reaction to a bad number, that's a huge indication that the bottom is already in, that the worst is already behind us, and then the market is starting to price in a better future. So these are the main two things. I'm looking at the price action in momentum stocks, which I believe are leading indicators, and we will see breakouts in momentum high growth stocks much before the market averages breakout. And then I look how the market reacts to earnings. And if you looked at if you watched my YouTube show back in September last year.
Yeah, I was following you. Yes.
Much before that breakdown happened, I was talking about how I see.
You were mostly staying away from this market that time during this sell-off. I would say.
And I even tried to short a little bit because I saw that the market was deteriorating. And of course, after we broke that 270 level on the S&P 500 in December, everything just fell apart very quickly. And I mean, most people that don't have experience, they focus mostly on the long side, and there's nothing wrong in that. But once you gain a little bit more experience, you should also focus on the short side, because market tend to be a lot faster during corrections. And as I said, it's important to realize every single year when the market's trending strongly up or down, and just to capitalize on those periods.
Yeah, exactly. Well, the next question, is your trading methodology scalable to a large size of trading capital? Let's say you want to establish a hedge fund with assets under management equal to $100 million. So is your strategy scalable to this amount of money? Or would you be a momentum trader and trade the momentum stocks in these circumstances as well?
I mean, capital size definitely is a big factor. And I don't know if my strategy will scale to $100 million, but if I have $100 million, I would definitely...
That's a matter of execution, because if you enter the market with a large order, let's say, it's a different story. No?
Yeah, that's true. But if you automate everything, I think it's possible to be a short-term trader, even with a bigger capital. But if you do everything manually, I think it's kind of impossible. And probably I would switch to being a longer-term trend follower, and just instead of holding positions for a few days to a few weeks, I would try to ride trends for multiple months.
Yeah.
But I think my strategy is scalable, but it needs to be automated for that.
Yeah, I mean execution. You mean possible execution of your trades should
Everything.
be automated.
Everything, because I try to focus, and I rarely own more than 4 or 5 names at the time. But for a much bigger capital,
yeah,
I think you need to take a lot more signals, probably hundreds of signals a week, and need to automate everything. Just entries.
To have wider diversification for this capital.
Yeah, just because you cannot really put like all your capital into one stock. You really don't have the liquidity for that. So you just need to allocate to more names.
Okay. Well, and the next question, what is your foundation behind your approach? I find some parallels with your approach and the Ken Slim trading methodology, because they also focus on growth stocks. Maybe you have something similar with what they use.
I mean, I look at trends, and I believe that stocks that are in established uptrends, they often have consolidation periods, the so-called range contraction periods, that often lead to continuation higher.
Yeah, that's a technical part. I understand this pretty clearly. I mean, fundamental part behind the
fundamentally
process.
I mean, I don't really think it's that important, just because the market is forward-looking. And as I said, we can see many companies, many stocks doubling, tripling, quadrupling with poor fundamentals. I mean, fundamentals, they are backward-looking. They looked at what the company did last year or last quarter, and the market is often forward-looking. That's the big difference between a company and its stock, because the stock price reflects the market expectations about the future.
But you do pay attention on some fundamentals, like the technology which company uses, the earnings reports, and the dynamics of the earnings, and some things like that.
I pay attention to how the market reacts to earnings. If there is a big earnings surprise, I mean, one of the screens I run is for big earnings surprises. Like if a company reports earnings that are at least 50% above what analysts expect. But it's a lot more important for me is to see how the market actually reacts to those numbers and to that surprise. The reaction is what matters. Like, because if the reaction is positive, there are big funds buying that stock, and they're likely to continue to support it. Or if the stock breaks down on big volume, that means that someone is distributing that stock, and most likely there could be a further downtrend. So I don't think, I mean, for my type of trading, fundamentals are not that important. Just because if a stock moves from $25 to $30 this week, it's not because all of a sudden that company sales went up 20% in that week.
Yeah, it might be the technical factors. All right, so the next question is, what is How do you distinguish elements of a trading process by their importance? For example, trade selection and stock picking might be 60%, the risk management might be 30% of importance, and the price action or monitoring the price action might be 20%.
I think market timing, as we mentioned earlier, is the most important element. Just because if you're in the right markets, when you're long, it's a lot easier to manage your trades, and you can be the worst trader and you can still make money in a bull market, in a rising market, and it almost doesn't matter what stocks you buy and when you buy them, when the wave lifts all boats. But if you're really experienced trader, you can take advantage of those periods. And in choppy market is the opposite. Like it almost doesn't matter which stock you pick. You see so many failed breakouts, failed breakdowns, or anticipation setups that just never materialize. That's why I think that market timing is even more important than equity selection. Yes, equity selection, can help you pick stocks that will go up. Let's say if the S&P goes up 10% in a quarter, you can pick stocks that can go up 50%.
Yeah.
High growth momentum stocks. But it's a lot more important to, I think the first step is to time the market correctly. And after that comes equity selection. So I would say 50% is market timing, and then 25% equity selection. And then I would say 25% risk management, but market timing is just an essential part of risk management. It's just...
Yeah, risk management. What about money management? So is it as important as market selection?
Yeah, of course it's important. I mean, I typically risk between 0.5% and 2% for each idea.
Trade.
For a single trade, yes.
Yeah. Okay.
And I mean, your viewers probably are familiar how to position size properly. Let's say if you trade $100,000 and you want to risk 1% of your capital per idea, so that means you're risking $1,000.
Okay.
So if you want to buy a stock that is at $20 with a stop at 19, that means you're risking $1 per share.
Yeah.
I mean, 1% of your capital is $1,000. You take that, you divide that by $1, which is your risk per share. So you can buy 1,000 shares of that $20 stock. That's a 20% allocation of your 100K. So this is how I approach my position sizing. It's based on a percentage of capital that I'm willing to risk, and that percentage does not stay constant for me. I mean, when I feel that I have an edge, when I see that I have an edge in a really strongly trending market, I would risk 2% of my capital per idea. And
so you have kind of A-class trades, which enable you to put at risk more capital than you
at risk.
Yeah.
And if I don't really see that I have an edge, I would trade a lot less and I would risk a lot less.
Yeah. Well, yeah, that's very good. Well, let's talk trading options a little bit, because you wrote a book about swing trading options. And of course, I have to ask you about options. Options trading usually is a multidimensional world, but you prefer to use in simple way. Well, in general, it might be picking the individual options, just naked call or put options. So why do you use options for trading? And do you use them because you want to protect your capital against morning gaps, or you want to get high leverage for your breakout trades? So what is the reason for...
Well, the main reason to use them is to fully capitalize on strong trending markets, being either up or down, because options in liquid stocks help you to fully capitalize.
So do you mean more medium-term trades, like holding a position for, I don't know, 1 month, 2 months, 3 months, or you use it for swing trades, which last no more than 2 days?
Look, the way I define swing trading, it could be anywhere between a few days to a few weeks.
Okay.
Like that's my definition of swing trading. In the right market environment, I utilize options so I can achieve better returns. That's as simple as that. I mean, options provide leverage, and that's why market timing is so important. You have to know when to use them.
Yeah.
like I don't really use them for hedging. It's very rare. Sometimes I would buy covered calls against a longer term position of mine, but I don't think that created a lot of alpha for me. So covered calls.
So you don't use really complicated strategies like, I don't know, even for directional trading, some traders use vertical spreads, for example, and some stuff like that. So you just use naked call options or naked put options in your trade.
Absolutely. I mean, I wouldn't call them naked. Naked is when you sell them, I would say.
No. Yeah, really.
And when you don't own the underlying stock. But when you buy an option, you know exactly how much you risk. Let's say when you buy a $5 option, which
why do I call them naked? Because the reason the word in an options trading world, if you buy anything, you have to sell anything simultaneously. So to build a spread, and that's why I call them naked. Yes, because
exactly what I mean, like a single option, basically.
Because the time decay is also the issue in options trading.
Absolutely, it's an issue. So you have a significant move in the underlying assets. And this is why it's important to know when to trade options, because there are very few periods in the year when it's proper to trade options on the long side.
So it's not an active trading; it's a selective, not very frequent trading when you use options. Only for trends.
I wait for certain markets. I wait for everything to align. For example, I wait for the Russell 2000. Needs to be trading above its 200-day moving average, above its 50-day moving average, and above its 10-day exponential moving average. So I need also the 10 to be above the 50 and the 50 to be above the 200. So that's a very rare moment in the market. I mean, we saw it in 2017, we saw it in 2018, but I only trade options during certain markets environments.
So does it really make sense in terms of financial result? Because you may analyze now, you may get back to a trading performance and see what works better, the individual stocks or options.
Absolutely, it makes sense. As I said, if you know how to time the market properly, options can substantially increase your return.
Yeah, well, but not risk if you do everything correctly. That's the good part of options trading, right?
I mean, every time you have to take into account that every time you buy a single option, when you're long an option, you risk the entire capital. So if you put all your money into one option, like all your capital, like tomorrow you might be out of business. So you have to apply the same position sizing techniques that you apply to stocks, and that if you risk 1% of your capital for a stock idea, that means you should risk 1% of your capital for an options idea. So that's why it's very entertaining to me every time when I see someone on Twitter or on stock tweets bragging that they made 100% on an option. That's not a big deal because you risk 100%. So you have a one-to-one risk to reward. That's nothing to brag about.
That's like trading futures, I would say. Employing leverage, they might be a double-edged sword, really.
Yeah, exactly. I mean, there is a lot of leverage also involved in options. So you need to be very careful with your position sizing. Like your main way to manage risk in options is position sizing. Yeah.
All right. The next question. Did you find the balance between trading and your life outside of trading? What is a trading routine? So how many hours do you dedicate to trading during the day? So how really does it build in your life?
I mean, I live on the West Coast in San Diego, California, and here the market opens at 6:30 a.m. So every day I wake up around 5:30 a.m. And I have a home office, so I work from my home most of the time, so I'm not stuck in traffic. And I mean, usually I'm prepared the previous day. I know the setups that I'll be looking at to potentially trade, and the market closes at 1 p.m. here, and after that I have the rest of my day to enjoy my life. And I'm very active. I play beach volleyball, I swim, I go to the gym a lot, I run. I really try to have a lot of activities outside of trading, and and you have to. I mean, you have to diversify your life. You should not be dependent on only on your work or only on one single area of your life. You need to diversify your life, just like you diversify your trading.
That's a big issue, not very much spoken about, because you have to really switch between trading activities to other activities as well. Well, and I would say you live in San Diego now, which is known for its really high cost of living. I don't know for the whole world, but in the United States, I guess that's quite an expensive city. And many readers and listeners would like to know how big trading capital you should have, or what does it take to live in San Diego, maybe trading other people's money or trading your own account, how big that account should be. Well, to your experience, how do you handle that?
You don't have to be a trader to live in San Diego. I mean,
I understand that, but if you are a trader, and let's say, and
it depends on your costs. I mean, everyone lives differently. Some people spend $30,000 a month. Other people spend $3,000. It just depends on your lifestyle and how much you spend. And yes, the cost of living here is relatively high, but people just make more money in general. No matter what job you have, you make more money than if you had the same job in the Midwest, let's say. Yeah. So everything evens out. I mean, I don't know what to tell you. It just also depends how good of a trader you are. If you're a really good trader, you can just work with $100,000 or $50,000, and you can still make a decent amount. And it also depends on the markets. If it's strongly trending, it's a lot easier to make a lot of money. If it's not, you may not even make anything. And this is why it's important for all traders to have other source of income. I mean, unless you have really a few $1 million at least, you should rely on other sources of income.
So when you're just starting out and you don't have much capital, so, well, what would be your general advice to those who are starting out now in 2019? So what capital should they have for the start, and what should they read? What should they focus on? Because there's so many books, so many materials over there. So what would be a general advice for those who are just starting out right now?
I mean, you don't have to have a lot of money to start out. You can start with a small capital, and just over time, just be patient and don't expect to get rich the first or the second year. Like, you would be lucky if you break even the first couple of years until you learn how to extract money from the market. And where to start? I mean, I don't know. You just have to start from somewhere. I mean, I've written 5 or 6 books. I think you can pick up one of them. I think they're very practical. Yeah. And they give a good foundation. And I think it's also okay to initially paper trade the first year, just until you learn what you're actually doing, because you're entering a field that is very counterintuitive, and it'll take time. I mean, read as much as you can. Like I've read all the Market Wizards books probably 2 or 3 times. There's a book by William O'Neill, How to Make Money in Stocks, also a decent book. But if you're looking for something more practical and shorter, you can check out my books on Amazon.
Yeah, by the way, the links for your books would be below this.
Yeah, just search for Ivanhoff. And you can also follow social media. There are so many people that are sharing setups and knowledge on social media. And when you don't have the necessary knowledge, it's okay to find a mentor, and even to pay for someone just to show you the road, pretty much.
Did you have a mentor in your trading career?
I mean, I've had many mentors, most of them indirect. Like, I've been reading their books, I've been reading their websites, I've been following their work. I mean, you don't really need to go to someone and tell him, hey, could you be my mentor? Because no one has time for that. Yeah. We can just follow their work, read what they post, And I mean, I've been working with quite a few successful people. Working with Howard Lindsay, who is primarily a long-term investor. There's so many.
Who had a profound effect on your trading? I would say that someone had turned around the way you think about the markets, and every trader have this turning point or tipping point, or the people who influence them the most.
Mm-hmm. I mean, I've learned a lot about trading from a gentleman from India. I think he's now based in the US. His name is Pradeep Bonds. And back in 2005, 2006, he was posting a lot on his free website about momentum stocks and and how to trade them. So definitely, he's had a significant impact on the way I approach trading.
Yeah, that's interesting because it's maybe not very popular, overhyped person on the internet. So, okay, so I will ask you to share maybe his name. Maybe some guys would like to see his social media if he's still in the sphere in the internet. Well, okay,
yeah, sure.
All right. So thanks a lot for the great conversation. So have a good day. I wish you to survive and thrive in this volatile markets, trading momentum stocks or whatever you trade. All right. So
thank you for having me.
Again, thank you so much. See you later and have a good day.